asked my followers which financial topic they want to know more about, and a lot of people said they want to understand tax better and they want to know how they can pay less tax. So that's why I made this video. Tax is one of the biggest expenses you'll have in your life, and some of you have no idea what tax is, how it's calculated, or how you can pay less tax. So in this video, I want to help you become tax smart. I'm a qualified accountant and I studied tax for 4 years. I also had to master tax for myself and for the companies that I worked for in more than 6 countries. So I have a good idea of how tax systems work, and I think I can share some good tips with you today. Without judging me, I'll also tell you that I have a special love for tax and I love figuring out ways to optimize tax and to legally pay less tax. As a disclaimer, you could be watching this video from anywhere in the world, so this is obviously not professional tax advice, and I would always advise you to consult a professional tax advisor if you need to. Nevertheless, you will get some good ideas from this video because I'll show you whether you're a full-time employee or self-employed, there are ways that you can reduce your tax bill. And if you're self-employed, you also might be wondering whether you should be operating as an individual in your personal name or whether you should be establishing and billing from a company. So we'll look at that too. My mission is to help you make smarter money choices, regardless of your level of wealth or your level of financial knowledge. So subscribe to my channel if this is something that you're keen to learn. The first topic we need to cover off is, why do we pay tax? Tax is a source of revenue for governments. They use this for public services such as repairing roads, maintaining water facilities, running welfare programs, and just general government operations. What many people don't realize is that tax is also a mechanism used by governments to influence the economy. They can reduce or increase tax rates and thereby reduce or increase disposable income, which encourages or discourages spending. So how does tax work? There are so many different taxes, but the 2 main types are individual or personal tax and company or corporate tax. I will also touch a bit later on other types of tax, such as capital gains tax, dividend tax, or value-added tax. But let's talk about these 2 first. Individual tax or personal tax is when you pay tax in your personal name. And this is usually when you're a full-time employee of a company. On the other side, corporate tax is completely a separate structure that is established when a company is incorporated and it pays tax according to its own accounting records. It has a separate bank account and it also has its own tax filings. If you're self-employed, you can either do tax as a sole proprietor in your personal name, or you can establish a company. And there is a misconception that incorporating a company and paying tax as a company is more beneficial. So we will visit the detailed calculations just a bit later. Individual tax is by far the biggest source of revenue for governments. In the UK and the US, it makes up about half of government revenue, whereas corporate tax only makes up 10 to 15% or even less. Individual tax or personal tax is based on income brackets, which increases as your income increases. And corporate tax is typically a fixed tax rate. So if we look at this example, this is just for illustration purposes because tax rates obviously differ from country to country. If you earn $80,000 annually, the first $10,000 of your salary would be taxed at 0%. Therefore, you will not pay any tax on the first $10,000. But then in the next bracket, for the amount between $10,001 and $50,000, there will be a 20% tax. Therefore, $40,000 will be taxed at 20. And then the next marginal rate would be applied on $50,000 to $120,000. Therefore, you will pay 40% tax on $30,000 of your income. Your total tax bill will amount to $20,000. And if we take the $20,000 over your annual salary of $80,000, that equates to an amount of 25% of effective tax. And that is basically like the average tax rate that you pay. So if we look at this in a different way, the first $10,000 that you earn is not taxable. The next $40,000 that you earn will be taxed at 20%. And the last $30,000, which makes up your $80,000 salary, would be taxed at 40%. And this is how marginal income tax brackets work. An interesting fact is that in Switzerland, where I lived, income tax rates are very low. On a $150,000 salary, I only paid 15% tax. I can make a separate video on this if you're interested, so let me know. If you're self-employed and you're considering setting up a company, it's also important that you take note of these income tax brackets, because if you want to distribute a salary to yourself, it's smart to keep the salary in the lower tax bracket so that you pay less tax. Let's see how you can reduce tax as a personal taxpayer. If you want to know how you can reduce your tax bill as an individual, there are two ways that you can be smart. The first one is making pension contributions that are tax deductible, and the second one is investing in a tax smart way. So let's look at the pension contributions first. Governments usually have schemes in place to encourage the population to invest towards their retirement. Depending on where you live, this could be a 401k in the US, a registered pension scheme in the UK, a retirement annuity in South Africa, and in Switzerland it's called the Pillar 3A. If we use the previous tax calculation I showed as an example, if you contribute $500 a month towards a tax deductible pension scheme, you will make $6,000 in total contribution in a year, and this will reduce your tax bill to $17,600, and you'll pay $2,400 less in tax. Usually these pension schemes give you a tax deduction when you make the contributions, but ultimately you will be taxed when you extract the funds. This is basically deferring your tax liability to a point in the future. But this is still smart because of two things. You contribute an amount before tax is applied, and therefore you can contribute a bigger amount which will compound more and ultimately have more value by the time that you retire. On the other side, by the time you retire and you extract these funds, you will likely be in a lower income tax bracket, and therefore you will also pay less tax. If we just do a quick practical example on this. Over 20 years, you contribute $1,000 per month and you earn a 10% return. Let's say you didn't know that you can do this in a tax efficient way. For 20 years, you take an amount after tax of $1,000, and in 20 years time, that would be worth $1.6 million. But if you could have taken that amount before tax, it would be worth $1,250 if your tax rate is 25%. And investing $1,250 over 20 years at a 10% return, that would be worth $2 million by the time you retire. So ultimately, investing an amount before tax versus after tax could actually mean $400,000 more by the time you retire. The second thing that you can do as an individual to be tax smart is investing in a tax smart way. And again, there are different accounts in different countries that you can use to invest in to make sure that you protect the growth and the dividends of your investments from tax. This does not have an immediate tax deduction for you, but it can have a significant impact on the growth of your investments if they're not taxable. Examples of these accounts is a Roth IRA in the US, a ISA in the UK, and a tax-free savings account in South Africa. Each country has a different limit on how much you can put into these accounts, but here's a quick simplified example of what the impact could be on your investments. Again, we're assuming for 20 years you contribute $1,000 per month and you earn a 10% return. Over 20 years, the contributions you made would have been $240,000. The value would be $1.6 million, and the gains, which is the difference between the investment value and the amounts that you invested, would be $1.3 million. And normally those gains would be taxable. Depending on the country you live, the tax on capital gains and dividends is different, but let's assume a 20% tax on that. If it's taxed at 20%, you would be taxed $270,000. And after tax, your investment would be worth almost $1.1 million. But if you invested this in an account where tax is not applied to the growth and the dividends, there would be no tax on the gains, and your investment would be worth $1.3 million. So that is almost $300,000 more because you were smart and made these investments in a tax smart way. So next up, we'll look at how you can pay less tax when you're self-employed or a freelancer. The first thing to note is when you're self-employed, there are usually much more business expenses that you can deduct from your income to pay less tax. So make sure you're optimizing and deducting those expenses where possible. We'll look at an example now. Then we'll look at whether you should trade as a company rather than in your personal name, and when does it make sense. So if you're self-employed and you're earning an income of $80,000 a year, you can likely make deductions for business expenses such as your laptop, your Wi-Fi, your phone bill, a portion of your rent if you're using an office in your house for your business, and also flights if you need to travel, or the cost of a camera if you're using a camera for your business. So if we assume an amount of $2,000 for a laptop, $5,000 for rent, electricity, and Wi-Fi for your office, 1,000 for flights, and 2,000 for a camera, your taxable income would be $70,000. And if we apply the tax rates that we discussed earlier, your total tax bill would be $16,000, which is $4,000 less than the $20,000 in the previous example. And that's because you were able to deduct those business expenses from your income. So if you're considering whether you should set up a company to operate your business in rather than doing this as a sole proprietor in your personal tax capacity, there are a few things to consider. The first thing is that company tax rates are usually lower than income tax rates, but the advantage only kicks in after a certain amount of income. The other thing to consider is that operating a company does come with extra admin, like the company needs to be incorporated, it has to file annual accounts and tax returns depending on the country that you're in, and it also will need a separate bank account that you need to manage. Of course, it depends on where you live, but I would expect you to be able to make the same business expense deductions from your tax income, whether you operate as a company or as a sole proprietor in your personal capacity. But you'll need to check these rules in your country. Let's look at the previous example again. When your income is $80,000 and after deductions, your taxable income is $70,000. If you set up a company and the corporate tax rate in the UK, for example, is 25%, you would pay $17,500 tax on your profit as a company. Compared to when you operated this as a sole proprietor in your personal capacity, you would have paid $16,000 in tax. So in this case, you actually paid more tax as a company, and it would not make sense to operate as a company purely considered from a tax perspective. But once your income goes past a certain threshold, it does make sense from a tax perspective. Let's assume your taxable income is $120,000. Based on the income tax brackets I use, your tax bill would be $56,000. And if you rather operated as a company, your tax bill would be 25% of $120,000, which is only $30,000. Therefore, you can save $6,000 on tax if you rather operate as a company. So let's assume you've now set up a company which pays less tax because you've reached a certain level of income. How would you distribute these profits to yourself as an individual to make sure that you optimize it for tax purposes? There are three things to consider here. The first thing is you could pay yourself a dividend, and this would be subject to dividends tax, which, depending on where you live, could be a much lower tax rate compared to a salary, because you could also pay yourself a salary to extract some of the income in the company to your personal account. And then it would be smart to revisit the tax brackets I showed earlier to make sure that you pay a salary that is within the lower tax brackets and that you don't pay too much tax. The next thing that you can do as a shareholder of the company is to take out a loan in the company. But you need to make sure you do it in the right way and you set up a loan agreement, because you might have to have interest on that loan. But this is definitely something worth considering and that you can talk to a tax advisor about. How you can work best with a tax advisor. Many people don't have the skills required to do their own tax returns. And I've often noticed that people are very scared and they almost feel like they're guilty of something without doing anything wrong when it comes to taxes. So I'm really hoping that you can change your mindset around that, because there is a very clear tax law that governs what you can do and can't do in terms of tax. I think it's important to understand that when you work with an advisor, you usually pay them a fixed fee, regardless of how much tax you pay. So it's quite difficult to incentivize an advisor to help you to pay less tax, because whether you pay less tax or not, they're still going to charge you their fee. And obviously this is not for all the advisors, and there are some great advisors out there, but it remains your responsibility to make sure that you optimize your tax to pay less if you can. To give you a quick personal story on that, the first year I moved to Switzerland, I wasn't familiar with the tax regime yet, so I wasn't comfortable doing my own taxes. I used one of the Big Four's tax departments to help me with my return, and I wanted to deduct the fees of my MBA from my personal income, which is in Switzerland an allowable deduction, because I did some research and I read up on this. And when I asked them whether I can deduct this from my income, they said I can't. And I actually had to push back and share some websites and screenshots from articles to prove to them that it is actually tax deductible. And in the end, I was able to get a $10,000 deduction from my income. But the point I'm trying to make here is that you can definitely push back and ask your advisor questions and come with your own research to ask them if something is deductible from your tax. And also, if you're willing to, I would encourage you to revisit your previous tax returns to understand what they have deducted from your income for tax purposes and which things they might have missed. And especially consider whether you have made any tax deductible pension or retirement contributions like I've mentioned earlier in the video. But your tax is something that you need to take responsibility of yourself, because an advisor is unfortunately not as incentivized as you are to reduce your tax bill. There are some other topics that I could also cover when it comes to tax, such as understanding PAYE or dividends tax, or how trusts work and how they can save you tax. I can also help you understand value-added tax and property tax. So let me know in the comments if you would be interested in these videos and I'll make them for you. If you enjoyed this video, please subscribe to my channel and you would be notified when I make some more in the future. I look forward to seeing you again soon.